Welcome, everyone, and thank you for joining us today. My name is Seth Foreman. I'm the CEO at Social Suite, and I'll be your host for today's webinar. We're here to explore a critical question. How can companies prepare for 2026 when the ESG landscape feels like a moving target? Regulations are shifting, political debate is intensifying, and yet investors and customers are demanding more transparency than ever. Today's webinar will be covering these questions and a whole lot more. So a couple housekeeping items. The webinar itself will last for about 20 minutes, and then we're going to run a Q&A session. If you do have any questions, there's a chat bar on the right side of the screen. Feel free to enter your questions on there. We do want to make this as interactive as possible. If we don't answer your question in real time, we'll get to it during the Q&A session. We are also recording today's webinar, and we'll be sharing the recording after the webinar itself. All right, so for those not familiar with Social Suite, we're an AI-driven sustainability impact and risk management technology platform. We help companies to identify, manage, and monitor their ESG risks and impacts through technology. Our core products allow for corporates as well as consultants to streamline their financial impact and double materiality assessments. And on our website, you can find all the different blog articles and different webinars that we ran. We've ran webinars on all different types of sustainability-driven topics, so feel free and browse around that section if you want to learn more and get additional content and learnings from the different webinars that we've done in the past. All right, so let's jump in here. I do want to introduce our speakers today. Of course, we have our Chief Impact Officer at Social Suite, Dr. Tim Siegenbeek van Heukelom. And then we're also joined and excited to have on MJ Privyk, who's going to be coming in and providing additional support and moderation for the webinar and the contents itself. I am going to leave the chat. You'll be in great hands with these two, and I'll leave it over to you. Tim, I'll take it away.
Excellent. Thanks, Seth, for that introduction, and welcome, MJ. Great to have you here. It's really, we're going to have a really good, I think somewhat informal, conversational kind of webinar today, where we're going to unpack what's going on in the world and how to prepare for 26. And I think I really wanted to discuss that with you because I'm really a big fan of your weekly ESG Insights, which is, if you don't know, a great a newsletter. So if you want to know what's happening in the world from a regulatory point of view, but also what do companies see, what investors do, what is coming out in terms of changes to standards, I turn to MJ's website and newsletter. So it's a great resource. So glad to have you here today.
Thank you.
With that, like I said, what we want to do is kind of in three sections. I want to kind of run through where are we today. So we're going to discuss the first part, the landscape. So what are the tensions, the uncertainties, and some of the expectations around ESG, or maybe if you even don't dare to call it that anymore, sustainability right now, and what are we looking at when we're moving towards 2026. Then we'll shift that to a bit more strategic thinking around that and planning. So how can you prioritize and plan on the things that you can control? So some things are out of your control. So what are some of the things that you can do? And then really take that, kind of bring that home to what are some decisions you can take today, some actions that regardless of the multiple futures that can unfold, will still create value for you as a company and for your stakeholders. So hopefully that will, at the end of the webinar, we'll give you some kind of background, strategic kind of considerations, and some takeaways, some things you can actually do. So that's the breakdown of what we're going to do today. And with that, I want to start with kind of looking at where we are today. And 2025, I think, is a good way to put it, is a lot of uncertainty, instability around sustainability, regulatory. We see there's a whole kind of, a mixed bag of moving forward, taking steps back, some mixed signals globally. The question then is, what is 2026 going to bring? Will that shape up to be a more stable landscape? Where are we today? And I think that's the first point where, MJ, I'd love your insights of what you're seeing. What do you see right now, and where do you think that might lead towards 2026? I know it's still quarter or so away before we get there, but I think it's a good time to just, from a strategic point of view, starting to unpack that somewhat.
Yeah, for sure. Thank you. And first of all, thanks for having me. Happy to be here, and always good to have these kinds of conversations. I don't think that there have been too many explicit articulated objectives for 2026 yet. I think a lot of people in the space are still a little shell-shocked by the year that we've had since late 2024. The pace of change has been even crazier than usual, and not in the good direction, or in all different kinds of directions. What I haven't seen or heard is massive layoffs in ESG or sustainability reporting. I think that was a serious concern earlier in the year of, if companies retrench, are people going to lose their jobs? We haven't seen that. There've been some changes, but I don't think we could call it a trend. What we haven't seen either are intentions or actions for companies to literally pull back for those that are already reporting. So companies that are already putting information in the marketplace, already producing a report, by and large, voluntary still in most markets. The intention is not to stop doing that. What I have been hearing or seeing from either customers or organizations with procurement practices is that they are not reducing their ESG-related, sustainability-related requirements, and also from companies that are in supply chains, so B2B companies that are servicing larger organizations. They are also not seeing a slowdown in the requirements, whether it's in RFPs or from their existing customers. So that's an encouraging sign that this driver is actually remaining. The thing is that it happens under the surface, right? When everything that happens in the supply chain is actually less visible to the naked eye. So we may have less clear-cut examples that it's still happening. We're also seeing investors continue to manifest their interest and their desire for ESG sustainability-related information in the marketplace, whether large institutional asset owners are withdrawing mandates from asset managers that are pulling back, whether it's investors signing letters in support of regulatory regimes such as the CSRD in the EU, statistics on responsible investment practices that really don't show signs of letting up, and then survey results of investors that are staying the course. So the overarching regulatory driver that we've been expecting to drive change at scale, that is definitely missing this year, but there's still a lot happening.
You got some really good points there. And I think in particular, the last one, I'd love to pick up on that. So what I'm hearing is companies are at large, especially if they're already doing sustainability work and reporting over the last few years, whether that be preparing for potential legislation or just voluntary reporting, they're not really kind of stopping doing that. There are no massive layoffs. They're just kind of moving ahead, likely to a degree kind of driven also by investors that say, I still need that information. It's still valuable to me, regardless of if there is regulation coming in. But with now the regulation has a particular role. And I think you really touched upon that. And I think that's the key thing where we see that, I think let's say the tier one companies that have been at the forefront of a lot of this, been doing this for some even over a decade, because they do realize that it's important work for their long-term value creation. So they've been doing all this work, but to the companies that have not started yet, and that's, I think, where we look at the EU now, we see that's quite in flux there. Is the omnibus going ahead? What does that look like? Larger companies are saying we're going ahead anyways, whether they change it or not. But it's that kind of that mid-range of companies that have not started yet. They're kind of, stop the clock. They're waiting. They're not sure yet. And maybe they are not going to go ahead. So I think your point about scaling up and getting everyone into this is really kind of valuable. Can you kind of, dig into that a little bit more about the role of regulation, why that is so important to you?
Yeah, absolutely. Actually, the role of regulations is to make information widely available, but more specifically also to make it comparable because it's standardized, reliable because it's externally assured, and then easily accessible because technically it should be digitized and XBRL tagged, and we can get into the details of that if we want to later on. This regulatory impetus was driven because of the demands of investors and large companies to some extent, saying we want this information and we want it to be comparable. For investors, information needs to be comparable because they're not looking at one company, they're looking at hundreds, if not thousands of companies, and they need to have information that they can look at for their portfolios, and also information that they could look at to do a comparative analysis in making their investment decisions, whether or not to invest in the company or what price to pay for those companies. So that's why regulations were actually coming into existence, and they were going to be addressing those issues. That is going to take some time. Probably it will happen over time. It will be slower. You're also seeing, climate change, climate-related disclosure regulations. That seems to be more sticky in most jurisdictions, especially with the IFRS sustainability disclosure standards. Climate change may be that issue to open the door to other issues. For smaller companies, they were also going to get pulled into this practice with regulations, especially again, the EU was leading the way in pulling in a much larger number of companies into the scope of regulations. That may not happen for some while. So now we're reverting back to the market drivers, the investor demands, the large customer requirements. What may happen because of that is, with regulations making the information directly available from companies to the users of the information, you didn't need to do those questionnaire things anymore, right? You didn't need to fill out a CDP or an S&P, and there actually had been somewhat of a pullback on that. With the absence of regulations, I think those questionnaires might actually have a lot more staying power. Why? Because they enable the collection of comparable information for a large number of companies. And therefore that meets the information needs of those investors, private equity or publicly listed, and information needs of large companies. When you're dealing with supply chains, a questionnaire like EcoVadis becomes maybe more relevant, but the concept is the same: collecting standardized information to make it comparable on large sets of companies.
And I think that's the key to large set of companies there, that without regulations, you still have a certain percentage of companies doing this, voluntary, well, maybe voluntary, investors are demanding it, so there is pressure there. But other companies that might not feel that pressure are kind of lagging behind, waiting there for an more clear impetus to get started. And with regulation, you get that at scale. Everyone needs to do it. It might be tiered, it might be a later start, but everyone needs to get on with it. So that data set is massive in the end. Everyone is doing it, and that's what we're looking for. So yeah, we see the regulations, they're evolving quite unevenly around the world, a few steps back, a few steps forward. I think it is interesting to see that Asia Pacific is, to a degree, in particular climate first, they are stepping up now. There's definitely some geographies there that are saying we're doing this. So that's really, I think, promising to see that across the world globally. We see in more and more jurisdictions doing something driven often by climate, but not just only. Yeah. The other question I think you've brought up, I guess, a political pushback. The question always is, has that really reshaped the conversation? Has that really made a change? I think you started already out saying that, well, maybe we don't hear as much about it. It's not the number one topic, which might be these days AI, something related to that. But if we pull back the cover, everyone is still doing it because it is important there. So I think that's quite important. Is there anything else from what you see, what you hear on the ground right now that might be interesting for companies to consider in this unstable environment going forward towards 2026? So anything that stands out from a maybe consumer perspective? I think investors is pretty clear, or from boards or otherwise, that you feel that that's good to be aware of.
I don't think there's anything new. I think there's refinement, it's difficult to have a simple answer to that question. I think there's refinement. I think there's refinement. I think one of the things that maybe we'll get into a little bit later on is, companies are still doing it. Doing what? And what are the investors and large companies asking their supply chains or their portfolio companies to do? Is it to disclose, or is it to disclose on managing important issues and therefore managing sustainability related or ESG issues? And I think that's an important question for companies to ask themselves, because they may not need to disclose. They may still need or want to manage those issues. And really what they're disclosing should be what they're managing, not the other way around. Disclosure was a mechanism, and we've been hyper-focused on disclosures the last few years, because that's where the regulations was happening in many instances, although in Europe it was much more comprehensive. But disclosures aren't an end in themselves; they're a means to an end. And I think companies in thinking of where they are at, what they should be doing, should really be asking themselves, why am I doing it, or why am I being asked to do this, and what am I being asked to do and why should I do that? I think those are important questions.
And I think that's the key. What we see with a lot of companies is that sometimes it becomes that compliance checklist. Are we disclosing everything we have to? Let's move on from there. But to your point, the ultimate aim here is that we understand, identify, manage, and mitigate any negative impacts we're having on the world or risk we're facing. And I think I always tell companies that don't get this is think about your corporate risk register. You're not once a year looking at that and say, we know our risks, and you move on. Actually want to manage those risks, mitigate those risks. And that's the same with sustainability. It's not just a matter of, we know what it is and move on. We actually want to do something. And I think that's the key here. So with that in mind, let's first look at that more strategic perspective about what can you actually do. And I think that, yes, companies are waiting for clarity, but who knows when that is going to come, and is that actually going to come? So what are we looking at? There might be multiple futures. It might be quite quickly that we turn the corner and see sustainability really kind of moving steps ahead, or we might be stuck another year in a bit more uncertainty there. But that doesn't mean that companies should not be doing things in terms of not just disclosure, but actually kind of understanding what their priorities are and to plan ahead strategically. So the question is, what are some of the things that it can be doing right now or in 2026 that are really useful exercises, regardless of what investors are demanding from you, whether you have to do a questionnaire or you get regulation? What are some of the, I think, fundamental steps that companies can take right now from a strategic perspective to get to a point where whatever future they're facing is a good starting point? What are the first things that come to mind for you in terms of strategically, say, you would be advising a company that says, well, we're planning for next year. We don't really know what's going to happen. What are the first couple of things that would be really valuable for a company to lock down now to do next year?
Yeah, great question. The way I like to articulate it, or the way I like to look at it, is that actions that companies can take are a function of three things to various degrees. Their intentions, what they want to do, their means, what they can do, and their obligations, what they must do. And those obligations can be either regulatory, whether it's environmental regulations or disclosure regulations, or planned obsolescence regulations, or contractual or commercial obligations in customer requests. So we are hearing and seeing more and more that companies are at risk of not getting a contract or losing a contract if they don't do certain things, manage certain sustainability related issues, and then obviously say what they're doing, or tell their customers what they're doing about those things. That's a commercial imperative. If you're going to lose a contract, if you're not doing certain things, there's an obligation for you do those things, unless, of course, you don't care if you lose those contracts. But what company in a profit-seeking context, would have that kind of logic? So really, it's those three things, and there's give and take. Some companies have a lot of means, some more limited means. Some companies are heavily regulated, others much less so. And some companies, have intentions of wanting to manage their negative environmental and social impacts and or generate positive environmental and social impacts. But what you want to do and what you can do are not necessarily the same thing. And so I think there needs to be an assessment, an honest assessment by every company of what those three things are, and strike a balance. Now, this leads us to the question, and I don't know how deep you want to go into ESG versus sustainability and impacts. And if we talk about double materiality, which really, how can we have a conversation on sustainability without talking about double materiality? But when we talk about, impacts, how much a company can address its negative environmental and social impacts is really a function of the system that it or we currently operate in. And when those impacts, when there are regulations in place, those impacts can be addressed because they're internalized. The costs of those impacts are internalized to the companies, and there's an impetus for the company to do something about it. By and large today, in many cases, the negative impacts of a company's operations are externalized. They don't have to pay. The costs are externalized to society, actually. They don't have to pay for them. And so if they were to choose to address them and therefore internalize those costs, can they do that and remain competitive and maintain a certain level of profitability? When we're talking in a context of profit maximization, that might become difficult. Now, every company is different and needs to make that assessment. But those are the realities that, companies need to be thinking about, and when they're assessing, what they want to do, what they can do, and what they have to do when it comes to sustainability. But I think that's a really, really good starting point. And then the other starting, in terms of the what you have to do is, who's asking you? I have to disclose. Do you have to disclose? Who's asking you to disclose? Does it make a difference? Because if nobody's asking you to disclose, why would you do it? Disclosing is providing information to meet somebody else's information needs. If nobody's asking you, if nobody has information needs, you don't need to disclose. That doesn't mean, and back to the earlier point, doesn't mean you don't have to manage those issues if those issues are actually critical to the success of your business and your ability to generate profits, cash flows, and to be resilient and to be successful over the long term. So you may actually want to be addressing those issues, managing them, not necessarily having to disclose. I think understanding your why, what it is you're being asked to do, but why you're being asked to do it, are basic questions that I think companies all too often skip, because they get right to the, well, I somebody's asking me, or I have to, or, oh, there's a standard. Okay, I'm going to apply a standard, and not really understand why they're doing it.
Yeah, I think there's a really good point there, that there's a lot of companies that are very reactive in that sense, that they, as soon as a request comes in, they'll try to address that and be done with it and keep going that way. And I think there's some companies are looking indeed for, like, what are our goals around sustainability? Can we be more proactive? Can we anticipate what is going to come in? And the other point that I think is really important, it's not just about the compliance. That is important. You need to be aware of that, but why are we doing this? And who is the audience there? So what is the information that stakeholders actually want? Who are our stakeholders? I think that's often a really key starting point, to understand our stakeholders that might want information from you. What is that information? When might they need that information? Managing that. And even in the absence of some of that, thinking about that, I think on the one hand, the risk management process, like, what are the risks we're facing? And most organizations have some kind of risk process, a corporate risk process, but I find a lot of them still really lack a good understanding within their existing risk of sustainability or climate related risk. So what we see is that within a business, it might be silos. There is a sustainability team, but it's not really linked to the GRC function or the ERM, operating in silos. So by bringing strategically those things together, It might not mean, to your point, that all that information needs to be disclosed, but you need to be aware of what is happening, what are the impacts, the risks, the opportunities that we're facing, and what is material in terms of we actually need to do something about right now or later. So thinking about those time frames, what do we need to then report on? So those things, thinking that through strategically, what are the things we have to do? Who is our audience? What are we actually managing as well? And I think that's the key where companies are moving towards. I think hopefully sooner than later is seeing that sustainability is not a compliance checklist that needs to be ticked in a sprint every year for 3 months and then we'd be done with it. It's that ongoing management, it's risk management, it's due diligence from a social and from an environmental perspective to mitigate any negative impacts and enhance positive impacts. So, but there can be a cost, and I think that's a key point that you flagged there as well. It's about that striking the balance. Like, what can we do within our means? How is that affecting our, in the end, our kind of our enterprise value, our bottom line, and where do we kind of get into overcommitment or things that we simply can't do for various reasons? So I think those things, getting that with management and the board discussed, if you haven't done that, it's a crucial conversation to have right now if you do want to get prepared for next year or in general. But then taking that then to, I think, more kind of decisive actions. Well, first of all is like have that conversation if you haven't had that conversation, and that can be hard. I always see that if there's not a champion there at that, I think, management level, it can be hard. If you're an ESG controller or sustainability person and there's no one supporting that at the top, it can be a challenge. But be persistent, be patient, and keep putting the pressure on. But in the end, also, I think it's really important to think about what is the key data that, from a compliance perspective, our stakeholders, what are the key things that we can already be collecting, regardless of the exact detail of what our stakeholders might be asking for. So what are some key things that are defensible data that we can build up, that we know companies or kind of stakeholders will be asking for? What are the key things that I think if we just look globally, what is both compliance, investors, maybe consumers as well, what are the key things that people care about these days? If anything, if you were going to collect, say, 5 data sets or data points, what are the key things that are really valuable to do, regardless of the exact future you're facing? But what are your thoughts on that?
Yeah, so we're talking here about universally material issues, if we were to use that jargon.
Yes.
I will answer the question, but before that, let's caveat that really it is super important for companies to understand the concept of materiality, material issues, and the fact that they are, by and large, whether it's investors, large customers, and even governments, being asked to manage those issues that are material to them. Materiality is context specific. It's specific to the type of industry you're in, the specific nature of your activities, your size, your geographic location, the jurisdictions that you operate in. And so every company has to do that exercise. And regardless of the lens of materiality that you decide to use, whether it's impacts, negative, positive, environmental, social impacts, or whether it's, financially material issues that can affect your ability to generate cash flows over the short, medium, and long term. So it is super important to try to do that exercise. It doesn't have to be hyper complicated. You can leverage information, scientific research papers and other sources of documentation that could help give you a leg up on that. But having said that, if you want to start even simpler, what are some of those issues that are potentially relevant to you because they're relevant to all companies? Climate change, by and large, is the ubiquitous issue because it affects everybody, and therefore it affects potentially all companies. And if it doesn't affect you, you also need to talk about that. You need to tell people, because that's what they want to know. If you're not being affected by climate change, you are, relatively speaking, to all other companies that are affected, a lower risk investment. But you only can say those things if you've done the work of assessing whether you are at risk or not. So, everybody should be measuring their emissions, because you need to know, do you emit a lot or do you emit not a lot? And for you to be able to say you're not a high emitting company, well, you have to do a minimum amount of measurement of your emissions and your footprint. And then climate change is a lot more than just emissions. So there's the emissions, there's reducing emissions, there's therefore mitigation of the risks associated with the consequences of a changing climate. And then there's also adaptation. The climate is changing. It is going to affect our lives from a personal and from a professional or economic perspective, whether we like it or not. The key is to know in what ways we might be affected. So for a business, in what ways might climate change affect its ability to source materials, its ability to procure components and materials from halfway around the world if it has a very widespread and international global supply chain. Are its own facilities at risk? And what does that mean for business continuity? I think companies have to ask themselves those questions, do that assessment over and look far out into the future, long-term scenarios. What might happen under different scenarios? How is the business going to be affected? What should companies or management be thinking about in terms of those different potential futures? That's what investors are asking for. Well, investors as one of the primary users of this information. That's what they're asking for. And the result of that assessment is what you can be talking about. So climate change is a ubiquitous topic. Biodiversity, yes, although probably much more context specific to the nature of the activities of the company. It is an equally, if not more, complex issue than climate change, much more comprehensive, many more ramifications affecting a big swath of the global economy. Back to some more universal issues. Any company that has employees, human capital is a material issue. How are you treating your employees? How are you paying them? Are they safe? Are they well? Do you offer training? Do you have trouble with recruitment? Do you have high turnover rates? Are you paying them living wages? Are you treating them with equity? Does your workforce represent the makeup of the markets that you are operating in or that you are serving? Not to use the word, diversity, although why we should be afraid of this word, I have no idea. Diversity is a good thing. Those are pretty much universal issues. Human rights, obviously, are a universal issue. Do you have human rights abuse, forced labor, child labor, in your, not just your operations, but in your supply chain? And this is where the whole concept, this is where it gets a little trickier, is you have to be looking not just at your core operations, but at your entire value chain. And in this case, in particular, your supply chain. And that's not an easy thing to do. It's not an easy thing to do. But, that is the direction of travel of where we are going, to ask yourself the question, to look into it. And then if you have to figure out if you have those issues in your supply chain. And if you do, how do you address them? So nobody said it was going to be easy. It's not something you resolve in 1 year. The idea is not to have a perfectly clean slate or a beautiful, disclosures of everything is fine, or we have no such problems, or it's about an honest assessment and honest measures to try to address these issues if you do identify them. I think that another one that would be universal, and then we would have one of each of E, S, and G, would be ethics and integrity, ethical business conduct. I think that is a pretty universal concept for any corporate entity. So I'll stop here.
It covers a lot, which is really great. But I think going back to your initial caveat there, that all of this is really entity specific. What is relevant to your organization? And the key thing to do now is to work that out. It's to think about what are our business activities, and not just your own operation. I think that was a key point that you made, is that what is my full value chain? So that's supply chain. Where am I sourcing particular products, inputs, or services from that help me with my business activities, but also where do my products and services end up? What's the end of life? Am I having impacts there? Are the particular risks there? And across that full value chain, also having a good idea around what are my dependencies. And that's a great point you made. If part of your main activity is producing a particular product, but you're really relying, your dependency is on a raw material input from an area that's very prone to, say, flooding or bushfires. And we see that increase more and more these days. And that might mean there's suddenly a key risk there that you can't produce that product anymore, or maybe certain times of year when there are floods or bushfires. That's something really important to be aware of. So kind of really expanding that scope to what's my full value chain, what are all my key activities, where are they geographically, what are the key risks and opportunities related to those activities, what are the impacts that I'm having, but also the dependencies that I need to run my business into the long term as well. So by doing all that and working that out, you get a really clear view on those key material issues that you need to work with. That is where you should focus your attention going forward. If it's not relevant to your particular organization, anything in your value chain, you don't have to either manage it actively, maybe monitor it, or disclose on that. So really getting that clarity on what to do is a really important step forward. And some of the issues you mentioned are very likely for most companies to be relevant. The other key thing is in particular on climate, but sometimes other areas as well, is being really clear that you've done the work if it's not relevant, in particular around climate, but also you do have key operations, maybe supply chain in an area that's the number one for child labor. You've done the assessment and it does not affect you. Be clear that you've done the assessment and that you're on top of all this. We also see a lot more modern slavery kind of legislation in different corners of the world coming up. So it's really key to do the work, understand where you are, manage what's material, but also be clear about the process. And I think that's what we also see in Europe in particular, where double materiality has been mandated. Of course, it is really important what the outcomes are of your materiality assessment, but it's equally important to explain how you've done that. How did you come to that decision? What was the process, the methodology? Who did you speak with? What data points did you use to determine whether something is material or not? So I think we've gone through a great amount of information here in the last, let's say, 30 minutes or so. I really want to thank you for that, MJ. There's a lot more we can dig into, and hopefully we do get some good questions. So with that, I do want to invite Seth back to the stage here and see if he's got any questions that have come up that, companies are interested in to learn about where we are today and where we might be heading into.
Yeah, really great job, both. That was super informative. I did get a couple of questions direct, and if anybody in the audience wants to add any other questions, feel free to add into the chat. So one question for MJ was, there's a lot of talk about driving value out of a company's sustainability efforts. How should companies be thinking about how to derive ROI out of sustainability? And if you have any examples that you could share that you've seen.
Yeah, that's the $1 million question, and it was a key theme in social media, in particular LinkedIn, for several months this year. It's a good question. I don't have a specific example that comes to mind off the top of my head, but I think it is possible to calculate the ROI of sustainability. I think there's quite a few credible sources out there to help you do that, whether it's Stern University's ROSI methodology or Daniel Aronson, Value of Values book, and he's written a lot about that. It takes a little bit of work to identify and articulate where the cost reductions and or revenue generation from sustainability investments. Sometimes, though, it gets a little more difficult because of avoided risks, avoided costs. Those are harder for companies to wrap their heads around and to quantify. That doesn't mean they are not important. And I think there we could revert to traditional risk management practices to make decisions on whether a course of action is warranted or not, even if you can't specifically measure ROI. And then there's a school of thought that would say, not everything needs to have an ROI. Not every specific action needs to have a specific ROI attached to it for companies to make the decision to act on it. So I'm sorry, I don't have a more specific or wow response to that question.
That is the $1 million question, and it's yeah, that was very helpful. So we got another question. So this one is more around this user asked, looking at today's political environment and the challenging environment that we're in, what's your general best practice in terms of how companies should be thinking about disclosures and what to disclose given the political environment?
Do you want me to try that one, Tim, or do you want to go?
Yeah, please go for it.
So first of all, I think we need to make a really important distinction between disclosing and communicating. To me, disclosing is a subset of communicating. It's much more structured, organized, standardized, usually audited, vetted. It's regularly or recurring. It's not communicating is something, and like I said before, disclosing is information you provide to meet somebody else's information need. Communicating is something you do to meet your own objectives and your own information dissemination needs. For example, corporate communications or marketing or advertising or social media. Companies proactively putting information out there because it's seeking to either generate sales or reflect well on its reputation, etc. Disclosing is a subset of that. And like I said before, if nobody is asking for information on ESG topics, then you don't need to disclose. You may want to communicate, but you don't need to disclose. I think that's an important distinction to make in the current political context. I think when the issue is material, and we've seen it from a few companies, especially on the topic of DEI, that have pushed back. There are a lot of those that retracted and pulled back. And I would say those that retracted and pulled back did so because there was no substance behind it. They were doing it because it was a fad, because competitors were doing it, because somebody was asking them to, but there was really nothing behind it. And they couldn't justify it. So when they were at risk of getting called on it, they just pulled it back. If you're doing it for real, if diversity, equity, inclusion is something that is intrinsic to your business because it's super important to your employees, to your customers, maybe even to your investors, you're doing it because it's material to your operations and to who you are as a company. You stand behind it. Others will stand with you, and we've had a few examples of shareholders actually supporting companies in their DEI initiatives and turning down shareholder proposals to withdraw DEI initiatives. I use DEI as an example because in the US right now is probably one of the most controversial topics and one on which companies have pulled back the most. So I would say if you're doing it for real because it matters to your business, I would say continue, do the work. And whether you speak about it or not, if you're disclosing about it or not, if you're disclosing, it's because you're meeting somebody else's information needs. I would, use those rules of thumb.
Agree. Well said. That's all the Q&A questions. So we're going to move on here. So as we wrap up, just as a quick recap. So this is a view of all the different services that Social Suite provides. If you are looking for any of these capabilities on the software side, certainly we talked a lot about materiality today. That is a core offering at Social Suite, both for single and double materiality, whether it's benchmarking, ESG reporting, and also social impact. And then we also provide a number of different solutions for on the more advisory side, from climate risk and carbon accounting and more. So please feel free to reach out if you're looking for any of these capabilities. And finally, as we wrap up here, do want to thank MJ for joining us today. Thanks so much for your insights. It was incredibly helpful for our audience. If you do have any questions, feel free to reach out to MJ directly. Her contact information is below, or for anything for either myself or Tim, you can see our contact information here. Other than that, thanks again for your time today, and look out for our next upcoming webinar. Thanks so much, and have a good day.